us. We're giving it a few more minutes for more people to join in, and we'll get started. If you don't mind introducing yourself in the chat and where you're joining from, drop your name and what city or state you're joining us from. Welcome to this exciting world of multifamily investing meetup. We have Manny from Sun City, Los Angeles. Welcome, Manny. Tenny from Charlotte, North Carolina. Lisa from Oklahoma. Welcome, Lisa. Thank you for joining us. Kai is joining us from Charlotte. Welcome, Kai. Hope you've connected with Tenny so he can talk your head off at some point. Sonia from Indiana. Welcome, Sonia. Thank you for being here with us. Marcus from New Jersey. Welcome. Scott from Fort Myers, Florida. Welcome, Scott. Thank you for joining us. And Annette from outside Charlotte, North Carolina. Welcome, Annette. Thank you for joining us. All right, we'll give it a few more minutes here.
Julius from Baltimore, the chairman himself.
Thank you. I'll be on the camera very shortly. How you doing? I'm Dr. Julius Oni, CEO and co-founder at Excite Capital. I welcome you today to the exciting world of multifamily meetup, presented to you by Excite Capital Investments. And co-hosting with me today are my fantastic co-founders and the rest of the team members at Excite Capital. My co-founders are Mr. Leslie Awasom and Mr. Tenny Tolofari. Leslie is our co-founder and director of operations, and Tenny is our co-founder and director of acquisitions. We also have other members of the team today. You'll be seeing on the call. Macy Belter is our used to be Missy Price, but not anymore. Is our director of marketing. Miles Hill is our acquisition associate, and he does many other things besides that also in the Excite Capital team. Kayla Daughtry is our investor relations associate. And we are missing Manny. Awasom, actually, Manny is also on the call. It's just not on video at this point, and he's our underwriting specialist. So on behalf of the entire team at Excite Capital, we welcome you to this fantastic presentation. And we hope to hopefully share some value with you today on how you can elevate your portfolio by exploring the advantages of multifamily real estate. Next slide. So everything we're going to be sharing with you today is obviously for educational purposes. We are not selling any securities to you today. The only thing I'm licensed to do is really replace people's hips and knees. So the rest of the stuff, certainly feel free to double check with your financial professionals. And this is really what this page says. Next. So these are the founders. I think we introduced ourselves to you earlier. And the reason why this is important is, I mean, we started this company because we saw a gap. We saw a gap in the people that were being served by this incredible asset class of multifamily real estate. We felt like we didn't see many healthcare professionals being served. We did not see any underrepresented minorities being served. And so we saw that gap, and we were like, you know what, we are going to take the gospel of multifamily real estate to this very special group of healthcare professionals of all diverse backgrounds and underrepresented minorities of all professional backgrounds. And that was how we started our journey about a little over 3 years ago, almost 4 years ago. And that is really, truly what led us here. And over the last 3 to 4 years, we've accumulated a portfolio of $168 million. And that sounds like a lot, and I'll tell you, just the three of us are not the ones who owns $168 million worth of real estate. The people who really own it is us with our community of investors. We essentially, for every single one of these properties, we acquire the properties in collaboration with other people. We bring people on this property ownership groups with us. Many of them are willing to just be passive investors because they love what they do. They want to continue to do what they love, but they also want their money to continue to work for them. And that's exactly how we've been able to, for each of the 6 properties that we've bought so far, essentially put together a great group of people, 40 to 80 people on each one of these properties, who are now co-owners of multifamily real estate. So my hope with our conversations today is that if you've not joined us on one of these property ownership groups, that you are going to take that step out today and start to also add multifamily real estate to your portfolio. So let's get a little bit of an update on the multifamily market in the US. Next. So compared to last year, the trend that the transaction volume has reduced significantly, almost by 70.6%. Actually, at some point, I think it was Q2, the transaction volumes were down by 75%. I mean, just put that in perspective. That means 3 out of 4 deals that were being done around the same time last year are not being done at this point. And really, that was because of the significant increase in interest rates, of the significant reduction in the number of deals that were coming to market. Please, you could go back to that previous slide. And all of these things contributed significantly to the fact that the sellers, even for the deals that were coming to market, the sellers were so far away from the buyers. The sellers still wanted to sell at very compressed cap rates, and the buyers were like trying to buy because the cost of capital was much higher. The cost of any loan was much higher. The buyers were trying to buy at a much lower prices, and so there was a lot of mismatch there. Next, please. Next slide. So the Fed obviously raised the rate to slow inflation, right? They did that because they felt like inflation was going completely crazy, and they needed to start to raise rates to slow the inflation. But the obvious side effects of that is the interest rate to also buy real estate was going higher, and that was significantly affecting the ability of buyers and sellers to agree on prices. Next. So the question now is, what's the rest of the year going to be like? Are we going to continue to experience this same trends where it's like 70% in decrease in transaction volume, where there's very little deals on the market to bring to the investors? And the answer is no. Actually, in the next quarter and the last quarter of this year, we actually anticipate a significant increase in transaction volume, and we're starting to see that trend already. For the first 6 months of this year, we barely could see any significant deals to underwrite that was worth the effort. And for those that we were able to underwrite, we were so far away from the from the whisper price, or from the amount that the sellers were trying to sell them for. And because of that, instead of doing a deal that would be subpar, we would rather not do any deal at all than bring a deal that is not ideal for our investors, because we hold our investors very dear to us. They are friends, they are family, they are people that are new friends, they are people that have trust, that have significant trust and confidence in us and have decided to go on this journey with us. And we don't take that for granted. So the what we've decided to do is, you know what, we are going to just wait it out, because we know there are a lot of properties out there where the buyers or the people who are going to be prospective sellers have loans that are about to hit maturity very soon. And so there's actually a point that is important to make here, that over 1,500 properties, you know, have a balance of about 18 billion in loan balances that are maturing within the next 18 months. So all of those people are going to either have to do three things. One, they are going to either have to refinance. Two, if they are really not able to cash flow on the property, they're going to have to either sell, and they're going to, or if they don't want to sell and they can't cash flow properly on the properties, they can't pay their mortgage, they're going to have to do a capital call. Capital call, for those that do not know, is when you go back out to your investors and say, listen, the plan wasn't what I thought it was. I need more money to keep this deal afloat for now. Or, and so they may have to do that. And third, if they do not decide not to do a capital call or sell the property, they may have to bring in a little more of a predatory type capital. Like they may have to bring in capital from private equity folks or people with a lot of cash on hand who want to jump ahead and take a significant portion of the deal at a preferred space on the capital stack. So what usually happens is someone comes in and says, yes, I'll save the deal for you, but I want this equity in the deal. And guess what? After you pay the bank, anything that's left over, I get my money first before you distribute to your investors. So those are some of the options that these people have. So a lot of them usually would prefer to come to the market and sell the deal, even if the deal is not going to yield the returns that they fully expect before. If they could get something and not completely lose out, then that's usually what they would do. And guess what? We're starting to see some of those deals come to market now. For the first time this year, we having multiple deals that we're underwriting actually come close to the whisper price, or to at least we are having the prices that we are willing to pay be a lot closer to what the seller was willing to sell for. So we are at that real cusp at this point where we can do some incredible things and find some great deals. Think about it as 2008, 2009, when the real estate market crash happened, and all those people that were able to scoop up great deals at that point in the single family space, particularly, well, some of those opportunities are coming in the multifamily space soon too, and we are going to be able to take full advantage of it. We're poised, we're ready, we have the investor base ready to go. Every day I get an investor telling me they are ready. They can't wait to engage with our next opportunity. And that opportunity is right around the corner. Next slide, please. And just before we even go into all of the details of this, let's talk a little bit about the benefits of multifamily investing for some of our friends that may be new to this platform. So let's dial it back a little bit. Why is it that we are so excited about multifamily? Reason number one, there is steady cash flow, right? With multifamily real estate investing, you literally you have a business. That's really what it is. It's a business that is generating revenue, right? It's not only generating revenue, it's also after you've paid your mortgage, you still have enough revenue to pay for a professional property manager who is managing the deal. After you're done with all of that and paid all the expenses associated with the deal, then you actually can also, so you could go ahead and like speed it up with the steady cash flow. After you've done that, then you actually now can then have extra cash flow. Whatever cash flow is left over there, you can now divide this amongst all of the investors. So you have a predictable monthly income. You have income stability as multiple tenants come in and go, because as they come in, as they leave in, you're filling it on the back end. So, and whatever cash flow is left, usually we're distributing that at the previously decided distribution percentage between the general partners and the limited partners. And this is just an example of a deal that we have, Lang Bank Loft, where the net operating income after we had paid off all the expenses were what you have listed that there. And that's a 112 unit deal. So we had like in April of that particular deal, we had 112, a little over $112,000, and there was a little dip in June, but then we were back up to essentially $112,000 also by July of that particular deal. And guess what? We take all of this together and then we distribute to our investors on a quarterly basis. Next. Next slide. Yep. So this is just giving an example of a deal that we bought and sold. The View was a deal that we bought for $12.5 million in April of 2021, and we sold it in November of 2022 for $17.8 million, a $5.3 million profit. That translated to about a 30% average annual return for all the investors that invested in that particular deal. That means that during the deal, in the 21 months that we held the deal, we distributed a certain amount of cash to every investor. And then at the end of the deal, somebody was asking me that where is the View in Charlotte? No, the View was in Columbia, South Carolina. And you certainly could look it up. It was originally Churchill at St. Andrews. We branded it to the View at St. Andrews. And this is essentially what we ended up with. So the gains from it were from the forced appreciation that we did. For someone who invested $100,000, they got an average monthly return of a little over $2,564. And for that particular person, also the gains from the forced appreciation was about $37,062. And the total returns for anyone who invested $100,000 into that deal, 21 months later, they ended with $148,000 and $726, $100,000 of that being their initial investment. So some people were asking questions earlier about why. I think somebody had asked the question about why we sold the View. Well, guess what? We saw an opportunity to sell a property that allowed us to go full cycle. You know, we bought this deal. We knew this were very attractive returns. This was November 2022. A lot of things were happening in the economy, and we saw a great opportunity to essentially get money into the pockets of our investors that wanted their money at that point. And for other investors, actually a great majority of the investors said, you know what, just move it right into the next deal. And we were able to do something called a 1031 exchange into that next deal. So, and we could go into details about that later. But next, in the interest of time, I'll keep going. We could always answer more questions later. Diversification is another one. So with a lot of our deals, we literally have them in different parts of the country. You know, we have one in Baltimore, we have one in DC, we had two in Columbia, South Carolina, we have one in Atlanta, Georgia, one in South Bend, Indiana. And we sold the View, so now we just have one in Columbia, South Carolina, and we have one that we are really close to putting under contract right now, and that's another one in Atlanta, Georgia. So we have a diversity of places where these deals are. And so as an investor, and we have actually in some of our investors that I invested in every single one of these deals, including yours truly. I'm invested on the limited partnership side in every single one of these deals, and is one of my diversification play. You were able to essentially invest in different deals so that one may hit it out of the park, one may do just as promised, and one may do a little bit below what was promised, but for the most part, and I'm happy to say that at least in this picture, every single one of them is doing at least as promised or better. So that warms my heart, and I think warms the heart of all of our investors so far too. Next. Appreciation is one of the most beautiful things about my multifamily real estate. You don't just increase. So there are different ways to increase depreciation. And one is, as we pay down the mortgage, we're essentially increasing the equity, right? In the property. That's one. Second, we have this thing called forced appreciation that we do, where we increase the value of the property by renovating it, bringing it from a classic unit from what it used to be like, white appliances, floors that are 20, 25, 30 years old, bathrooms that are outdated. We bring it into the new age. We bring it into 2022, 2021, 2023, whatever year it is. And then we are able to generate more income on that particular unit that was just renovated. We turn around those clubhouses. We make them modern. The pool houses. We put in dog parks. We put in sports complexes if needed. All of these things makes the tenants willing to pay just a little more to be in a nicer environment. And that little bit of just additional payment from the tenant exponentially increases the value of the property, because the value of the property is determined by the net operating income divided by the cap rate. The cap rate, we don't really have much control over. That's determined by the market. The net operating income, that's what we are increasing by forced appreciation. And then the other way that we also is the organic appreciation of the properties. These properties also just have organic appreciation that occurs over time, and multifamily properties essentially 10x anything that you are able to do with single family with regards to appreciation. Oh yeah, this is just an example of how forced appreciation works. So this example is exactly what we did in the View. So the View was 132 units. By increasing the average rent by 150 after we had renovated the entire clubhouse, we put in a spin studio or a cycling studio, a little gym in there. We put in bike racks. We renovated a bunch of the apartments. Literally by doing that, $150 average more rent times 132 units times 12 months divided by the cap rate, we were able to increase the value of that property significantly. In that, by the time we had sold it, we had increased our value not by 4.752, but by $5.3 million. Next. So another benefit of multifamily, and one of the reasons why we are super excited about it, is the tax advantages associated with this property, with this asset class. The IRS actually encourages us to to participate in real estate, and they do that by providing significant and incredible incentives, particularly with something called depreciation. So depreciation is this concept where you essentially account for the wear and tear of the property over time, you know? And this depreciation doesn't mean that the property is depreciating. Some people mistake this for, it just means that you are being given credit for the loss in value of the property over time. And one of the ways that we do it in multifamily properties is we do something called a cost segregation study. We bring in a cost segregation expert, which is usually a CPA and a structural engineer. They come in and they depreciate everything besides the land and building. And typically for every $100,000 invested, you could get depreciation of anything between $30,000 to $60,000 easy, depending on the property. So if you were one of those people that invested $100,000, you were looking, and the depreciation was $60,000, you could now take that depreciation, even as a limited partner, you could take that depreciation and use it to offset all of the cash flow that you're getting on that property. That's one. You could take that depreciation and use it to offset any passive income that you have from other sources. Okay, I mean, who would not benefit from paying $60,000 less than their taxes because they're able to offset it, right? That's one. And then you could take that depreciation and then use it to offset any if you an active if you've achieved rep status, now you can use that depreciation to also offset any active income that you have. And if you don't know what rep status is, that's real estate professional status. There are some requirements for that. You have to kind of actively participate in real estate at a certain number of hours a year. You can look that up, real estate professional status. When you're able to achieve that and you have this depreciation, now you can use it to offset even your W-2 income from other jobs. You can use it to offset your 1099 income from other jobs. It's incredible. And it's a strategy that those of us at Excite Capital and other real estate professionals throughout the country are taking advantage of, and it's legal. It's expected of us. I mean, the IRS clearly states that you are responsible to pay just the right amount of taxes, not a single dollar more. And it's the onus is on you as the individual to make sure that that is the case. Next. So this is just exactly what I was trying to explain before about how a cost segregation study can benefit you. I just try to explain, I just pretty much explained it in significant details there. And we, in the interest of time, we'll keep moving right on so that we can get to the rest of this. And so what's a 1031 exchange? I had mentioned it earlier, talking about the tax savings. The 1031 exchange is a tax saving strategy that essentially allows you to invest like sales proceeds into a similar properties. And by doing that, you defer any capital gains tax. And that way you can fuel your portfolio growth even faster. So the 1031 exchange is what we utilize when we moved a lot of our investors from the view and moved it through a 1031, moved all of their gains and their returns into the new deal that we bought, because that way they didn't have to pay taxes on that exchange. And the entire fund can continue to grow at a pretty accelerated pace. Eventually, if you decide to take the money, you may need to pay either short or long-term capital gains taxes on it. But one of the strategies that a lot of real estate folks do is just continue to grow that. And eventually when they need to take it, they usually have enough depreciation from even other investments to offset any capital gains tax that may result. Next. Also, multifamily real estate is a fantastic inflation hedge. Fantastic inflation hedge. When you look at what the stock market does in relations to what multifamily does, you'll be surprised. As the inflation goes up, rents go up. Did you notice that when inflation was going up, one of the ways that people were tracking it was essentially looking at how much rents were going up throughout the country? That was a reflection of the inflation. So you can imagine what that did to the value of the multifamily properties at that time. Now, as inflation is going down, guess what? Rent is kind of stabilized. Typically, rent don't usually go down. If you guys have ever lived in apartment complexes, I'm not sure if you've ever seen the rent all of a sudden start to go down. Usually it goes up, it stays flat, and sometimes it may go down a little bit for the most part, but it either stays flat or continues to go up again. There's usually about a 3% escalation that occurs almost every year that tracks with normal inflation. In high inflationary environment like we had recently, where inflation was up to 6, 7, 8%, then rent also goes up to match that. And if you look at the trends of multifamily and see what happens with the stock market yo-yos up and down, you would notice that the value of multifamily real estate has stayed relatively even. There may be a tiny little deep, but for the most part, the values of this property continue to escalate. And long-term wealth building, the holy grail really is that you eventually start to hold a lot of these apartments for the long term. Because when you hold this real estate for the long term, it's really hard to lose money. It's really hard to lose money on a multifamily apartment that you're able to hold for 10 years or more. So, but right now, our strategy is to combine with some where we're able to return money to our investors so that they could do with it what they need to do, and combine it with others where we are going to hold long term and maybe even refinance, get some money back to them, and keep them in the deals while they're making infinite income on that particular deal. So that there are different strategies to growing long-term wealth, but it's really important to note that no matter what you do, you cannot save your way to wealth. There is no way that you're going to be able to save your way to wealth, because by putting it in the savings account, even in a high yield savings account, you're still not going to be able to get the kind of growth that would help you live the life of your dreams. And certainly retirement accounts are there and they may help, but they still, I was at a conference this past weekend where they were talking about retirement accounts. And even the financial advisor was talking, I posted a question to him. I was like, why is it that you keep talking about this tax deferred account and now you can grow significantly in it? I was like, how much do you think an average person in this room is going to make have in their accounts by the time they retire? It's like, yeah, between $2 to $5 million. I was like, okay, great. And this are doctors. I was like, if you have $2 million in your account, that means a 4% disbursement at the time that you're going to retire, that's $80,000. You know, these are people making $200, $250, $300, $400, $500,000. Now that's $80,000. That means what you're saying, and they still have to pay taxes on that disbursement. So, so you are saying that, well, it's like, yeah, that's the whole point. You're going to be making less, so you'll be at a lower tax bracket. I'm like, everybody in this room does not think that they're going to be making less when they're retired. You know, but the reality is, with all of these retirement accounts that are focused on investing in Wall Street, the expectation is that you're going to be making a little less in retirement. And I bet if I was to ask all of the people in this room right now, all 32 people in this room, that how much do you think you're going to make when you retire versus now? most people in this room would say, I would still like to keep my lifestyle and my quality of life the same exact way. I don't want to have to downgrade. Well, the only way to really make sure is to take charge now, not just depend on that retirement account. You have to start thinking about ways to make your savings now work for you. And one of the ways that you could do it, not the only way you could do it, but one of the ways that we found that you could do it and do it very successfully is certainly by investing in real estate, particularly multifamily real estate. Single family real estate is good, no questions about it. But when you really want to accelerate your wealth growth, particularly if you're a busy professional and you don't have time to start chasing tenants and dealing with termites or toilets or all those things associated with managing your own small portfolio of real estate, then a great way to do it is partner up with folks like Excite Capital, partner up with other folks and start buying larger properties together, and that's essentially what we offer you at Excite Capital. Is our call to action for you is that join us. Let's all dance together and let's go ahead and buy this large multifamily properties. I'm glad to say that now we are not saying this is what we can do with it. This is what we can do when we all work together. What we're saying is this is what we have done. We have done it before. We've actually gotten there. We've bought properties. We've added value to it. We've sold it at a significant profit, and also provided significant returns to our investors. Now we just got to do it at scale. Now we just got to do multiple ones. And my hope and my call to you today is that hopefully you'll join us on this journey. We have a new ebook that we are going to release free of charge to you. You can just get to read it. It kind of goes over a lot of the same things that we just went over. And it just kind of talks a little bit about an hypothetical investor called Dr. Carla Johnson, who also is interested in real estate investing and all the different advantages of real estate investing or multifamily real estate investing for this doctor who loves what he likes to do, but also wants to make his money, the money that he's saving, go to work for him. So I hope you will get an opportunity to read it. And if you have any questions, certainly reach out to us. We'll share with everybody that it's on the call today for sure, and with any of our community members who may be interested in reviewing it. Processes and strategies. We identify the deals, we acquire them, we improve them, we exit them. I know there are a bunch of questions going in the chat right now. We'll certainly answer every single question to your satisfaction before you leave today. That shouldn't be a problem at all. So, and usually some of the things that you could do to make sure that you are elevating your portfolio, that you are making sure that you are achieving the same things that we have and even better is, one, you have to educate yourself and obviously set goals. The journey of 1,000 miles starts with the first step. You have to decide that, I'm going to take the bulls by the horn, and I'm going to essentially go on and take charge of these properties. Take charge of this of my financial future. I'm going to decide that, I'm going to start learning as much as I can about multifamily real estate. I'm going to start learning as much as I can about investing in this deals. I'm going to learn, secondly, as much as I can about reviewing these deals and doing my due diligence, not just on the property, but on the people that are putting the deals together, people like Excite Capital or other partners that you decide to go with. Like, you need to be able to review deals and make sure that this is an appropriate deal for you and that this is a good fit for your portfolio. A lot of what we teach on Excite Capital on this platform certainly will help you to become better at learning how to review and these deals and determine what deals are ideal for you. And then you gotta also learn how to maximize your returns. Like, you know, once you identify the opportunity to add value, and you want to make sure that you are not just taking that money and going to buy something that is not generating income for you. You want to figure out a way to essentially, you know, have a long-term view on this. Yeah, get the returns, but then continue to grow it in whatever ways that you think is appropriate for you. You certainly want to be able to monitor your portfolio performance and constantly check each investment to make sure that things are going well. You have to be able to go into all of your investor portals, see how your portfolio is doing. When you go into our investor portals, you can see essentially every deal you've invested in, how those deals are doing. You could click on the deals and kind of review what's going on. And every month you get a financial package where you could review the details of how every deal is going, when the deal is struggling, when the deal is doing fantastically well. And every quarter you get your returns in form of cash flow from the deal. And then you got to learn how to form partnerships. You got to be able to form partnerships with other folks that have the infrastructure, folks like Excite Capital, like Phoenix Capital, like other folks that essentially now have the infrastructure to be able to put things together, put the brokers together, put the property managers together, put the CPAs, the lawyers, the loan brokers, everybody together, to the general partner team together that's going to be able to implement the deal. You got to make sure that these are people that have your best interest at heart, that are always going to be watching us for your best interest. And at Excite Capital, we operate based on our core values. Our core values of humility, our core values of growth and abundance, our core values of persistence and determination, our core values of daring to be unique. And when we pursue all of these core values and put them together, that's what guides our decision to either pursue a deal or not pursue a deal, to share, be radically transparent with our investors, even when we have the right to not necessarily share details with them. We make sure that, because we also are professionals, we've been there, done that. We worked hard for our money. And so we want to make sure that we are good stewards of your investments with us. Having said that, we can move on right next to, this is our portfolio so far. We have the Griffin, Elevate on Main, Land Bank Lofts, Ascend and Stone Mountain, 101 Elwood, and we sold the View. That's the one I talked about earlier. It's a total portfolio of about $168 million. Go for next slide, please. And those are the properties right there. You can go on our website, get some more details on this particular deals, and we are more than happy to give you as much details as you need. This is the team. Once again, I introduced every member of this team earlier, and I am very fortunate to be a member of this team. If you want to know more, you want to learn more, you want to continue to learn from our community, that's the number to text Wealth to. And I want to end this as quickly as possible so that we could get into the questions, because that's usually the most fun part of this for me. Thank you. And Leslie, you want to run the questions?
Sure, absolutely. That was fantastic, Dr. Oni. Yeah, we have a lot of activity, a lot of questions in the chat. Thank you guys for engaging. And if you have any more questions, please drop them in the chat. We'll be going through the questions. I want to make sure I don't miss anyone. I'll start with how much is the anticipated buy-in?
Oh, so yeah, so our minimum investment is usually $50,000. Usually, on most deals, when we first started, on most deals, we would need to raise equity of about 1/3 of the total value of the deal. So if the deal is $30 million, we would need to raise $10 million. And at this point, because of the loan and mortgage environment, in the interest rate environment, we usually have to raise close to 40, if not 50% of the required equity on the deal. So, for example, the deal that we working on right now that we may have under contract, that's going to be about a 40-something million deal. So, assuming we get it for 42, $43 million, we would need to raise close to $20 million for that deal. So usually we raising at least $50,000 from each investor. The largest check we've gotten so far is $500,000 from an investor. My anticipation is that on this next deal, we're probably going to have a few $1 million checks based on some of the interest, but I'm looking forward to it.
All right. There was a question from Sonia Winslet. Why was the view sold if returns were attractive?
Yeah. So that's what I was trying to. I think I saw that question when I was presenting, and I tried to answer it. That well, one of the things. Guess what? I'll tell you this. If we did not, one of the things, I'm going to be radically transparent here. If we did not sell that deal, right, and we weren't able to generate those type of returns for investors, guess what? That same fantastic colleague will be asking, why have you not closed on one deal, right? You've never done this before. So you just stay talking about something you've never done before. So that's a great motivation to sell. But interestingly, that's not the greatest motivation for us when we sold. We sold that deal in November of 2022. The interest rate environment then was essentially escalating. That when we got the broker's opinion of value for that deal, that's the way you can essentially assess the value of a deal. The broker's opinion of value actually was closer to $20 million. And we saw the value of that deal slowly dropping from 20 million to 19 to eventually we sold it at close to 18, 17.8. If we had waited even longer than that, we'll be talking about 16, and we bought it at 12.5. So we'll be able to generate even less returns. But that's why it's important to always test the market, to make sure that you check in to see when is the right time to go in, when's the right time to come out. At that point, we've polled a few of our investors, of our key investors, and say, listen, if we had the opportunity to sell this deal at this point, would that be a good idea for you? And given the uncertainty at that point, the vast majority of them said, hell yeah, go for it, sell it. And I'm glad they agreed, because we are that better for it right now, because now we've gone full cycle on the deal, and we are happy to say it. And second, we were able to, and the vast majority of those people said, you know what, move my money right into the next deal. So remind me, Leslie, the exact amount, $3-point-something million of that profit.
About $3.1 million was rolled over to 110.
Of the $5.3 million, $3.1 million of it went straight into the next deal, because people were like just so excited that, my God, you gave me 1.5x of my equity. Keep it going. And I'm happy to say that same deal that we rolled that deal into is doing fantastically well. We've turned that deal around. That deal went from a DSCR, that's debt service coverage ratio, that was much below 1 to over 1 now. And the bank is super happy. Fannie Mae is super happy. That deal is off the list of the watch list now. So I'm super excited about it. So that's usually why it translates into from $100,000 invested, you could get between $30,000 and $60,000 in depreciation.
All right, great. And Sonia had a series of questions. Sonia, I love your questions. These are really good questions. So I'm going to go one after the other, Dr. Oni.
Yeah.
The first question is, what was the source of capital for the 17.8 million purchase of the view? Any loans, average investment per investor? I think
That's
she meant the 12.5 purchase
yeah.
price.
We bought it for 12.5. We sold the 17.8, and for that 12.5, I think we raised 5.65 million, if I'm correct.
5.3.
5.3. Sorry, 5.3 million is what we raised, and that money came from. I forgot how many investors now because we've had so many deals, but I think it was at least 60 investors, maybe even closer to 70. The average investment in that deal was, I think, 60 something thousand dollars.
52,000.
62,000, yeah, something like that. Yeah. So that's the answer to your question, Sonia.
And yeah, we did have a Fannie Mae loan on it, which is like a federally backed loan at 3.45% on that deal.
Yeah.
And
So what we do is we raise capital, and then we get a loan as to balance the capital. So we have the capital is the down payment. It's going to be the renovation amounts. It's going to be the acquisition fees and things of that nature. We put all of that together. We raise that capital, and then go ahead and get the loan to balance to get the balance of the money to acquire the property.
now, after purchase of a property, are additional investors allowed? For example, for renovations, what is the source of renovation funds?
So that is already raised as part of the initial capital raise. That we are raising all of that capital as part of the initial capital. So we don't. Anytime you go back to the investors and start asking for more money, that's called a capital call. That's a bad thing in our world. You want to make a promise and deliver on that promise. That's the premise here.
So once we create the ownership group and we raise the complete funds for that ownership group, that group is closed. We cannot allow any more investors on there. So the raise is usually calculated to account for everything, including renovation funds and reserves.
Yeah, because essentially everybody that comes into the deal now owns a portion of the deal. You can't now just bring someone in because there's 0% left of that deal at that point once the deal is closed.
Next question was, whose name is on the deed for each property? Would my contract with Excite be specific for the property or general investment into Excite?
Oh, I see. So your investment is specific for that property. Remember, this is an LLC that is being created to own the property, and you are a part owner of that LLC. The good news is, as a passive investor, you are a part owner, but you literally have no liability because you're a limited partner. I mean, for the legal minds in the room, you would know that, right? The general partners, we usually own anything between, in a lot of our deals, we've owned everything between 20 to 30% of the deal. And I think somebody was asking about how we get paid. This is how we get paid. We usually own about 20 to 30% of the deal, and the limited partners own about 70 to 80% of the deal, depending on the deal, right? And then we usually then structure it so that your win is our win. Usually you, as the investor, you sit higher on the capital stack before us. So there's the bank that gets paid first, and the capital stack then has the investors, the limited partners. Sometimes we have different classes of limited partners. Some classes have a preferred status. Some of them, as we move forward, may just want, cash flow, and that's it. Cash flow and a preferred spot on that equity stack. And then the next folks are the limited partners, meaning people who are passive investors who are just who are participating in the upsides of the deal, in the profits of the deal with us. And then last on the list is going to be the general partners. So we are going to make money when you make money. But that's our encouragement. So if we are able to do so well that there's enough pie to be sliced for all of us, then guess what? That's when we do well. Now there are things called the acquisition fees that is standard across all of these deals that the general partnership needs to run the deals, and that usually goes anywhere between 2 and 5% in the world of multifamily, and that usually comes at the beginning also. But typically, most of our deals are anywhere between 2.5 and 3% with regards to acquisition fees. When I said the general partnership group owning 30%, by the way, that's not just Excite Capital. We make it a big point to bring in other folks to join us in these deals, especially people who are also still trying to learn but want to participate on the active side. They want to actually learn how to start buying these deals themselves. We started out as passive investors with other folks, and then we started to move into the active side and started to become general partners with all those other folks too. Learned how to buy these deals, and now we've become the lead general partner on most of our deals. So where we are the ones kind of like orchestrating everything, bringing in the appropriate general partners who are going to bring some value. Some of them are great asset managers. Some of them are great at just being a key principal. What we call a key principal is someone who has the net worth to essentially even better augment the deal. Like, for example, if you need to buy a $50 million deal, the general partnership group need to be worth at least $50 million, and we need to have at least 10 to 15% of the value of that property in liquidity to be able to qualify. And for Fannie Mae loans, we also need to have Fannie Mae experience. So I think someone was asking earlier, like, how do we qualify for Fannie Mae? Well, guess what? You need to have somebody with Fannie Mae experience on the general partnership team. So on our first deal, guess what? We had to bring someone on like that. On subsequent deals, we don't need that anymore because we have more than enough Fannie Mae experience at this point, and we are considered a valid, legit operator because we've been doing this for 4 years. Yeah.
The next question is, will the amount of return be based on the number of investors for a property? Is there a cap on the number of investors per property?
So yeah, there's certainly always like some limit to the number of investors because there's only so much money we can raise. So the investment, the raise is usually first come, first serve. There's been many times when people are like, oh yeah, I'll bring my money later. We'll bring it later, and then they end up kind of lollygagging for a while. And when they're ready, we like, sorry, we can't take it anymore. The deal is completely closed. We'll make sure you see, you get to see the next one as soon as possible. That has happened many times before too. So it's always first come, first serve. We have a fixed amount of money that we have to raise. Once we raise that down to the last cent, then we cannot take a single dollar more.
Our tax forms distributed to each investor in January of each year, detailing the amount of depreciation that the investor can legally deduct.
There's something called a K1 that we send out to everyone.
Yeah.
The K1.
Go ahead.
Sorry. The K1 is essentially going to outline all of these things for you. It's going to outline your distributions for you. It's going to outline what kind of depreciation you're able to take. And most CPAs can read that and understand how to apply it to your taxes.
I wanted to add that make sure you have a CPA. If you're going to invest in multifamily asset, make sure you have a CPA filing your taxes. Are income and expense statements available for each property? Asking because the return per investor is after expenses and will likely be detailed expenses, payroll, etc. that decrease the income.
So if I understand the question right, they're asking is the finances of every property going to be sent to the investors?
Correct,
absolutely, yes. Absolutely. So every month you're going to get an investor update
we think this is extremely important. One, because it allows you to start to understand the lingo. It allows you to start to understand the operations of these properties, and for you to do as deep of a dive as you so desire, so that you can really start to understand how these properties work. Secondly, it also allows you to see if tracking with the increases in net operating income as we promised, right? So a lot of this monthly, and you could see when there's like a little bit of a challenge on the deal. You could see when there's like recovery. You remember that picture that I sent that we showed earlier of Land Bank Loft, the net operating income? Yeah, so you see that we were like at $112,000. The income dipped a little bit, and then it came right back up to $112,000. Yes, those are the types of things that you may see, and you'll be able to ask questions like, okay, what happened here? Why did this dip? And what are the plans to? That's what we do. We meet with the property managers every week to make sure that they are following and tracking with the key performance metrics, the KPIs that we've set for them, so that they can, so that we can make sure that we're tracking with our business plan. This requires a lot of systems and processes. It requires a lot of planning. It requires a lot of a dedicated team, and that's what we have at Excite Capital.
Next question is, would my financial advisor be able to purchase on my behalf is this a direct relationship between Excite and myself?
No, your financial advisor won't be able to sign or purchase on your behalf, but maybe I didn't understand the question right. If your financial advisor is just transferring the funds into the deal, that's completely fine. As far as it's your funds, it's fine, but you will be the one signing the operating agreement, the subscription agreement. You'll be the ones reviewing those, and you could take it to your financial advisor to get advice and make sure that it is appropriate for your portfolio. But and we have had people actually have their financial advisor review and ask those questions, and that's completely fine. I think that's within your right.
And you could also invest in this using a self-directed IRA account. So if you have a self-directed IRA account that's managed by your financial advisor or financial firm, yes, just make sure that it's structured to be able to invest in alternative assets like real estate. And you could certainly use funds in there, and that IRA is going to represent you as the investor.
Absolutely. And you can invest with your trust, with your LLC, with your self-directed retirement accounts and cash.
Yeah, that was a question from Annette that you just answered about the LLC.
Oh, okay. I didn't know that. That's great.
Yes. You can read the room, Chairman. And a question from Oyenike, how do we get the ebook?
Oh yeah, we'll send it to everybody that registered for this. So watch out for that. You'll get that in your email.
Does Excite charge any fees? That's a question from Sonia.
Yeah, so Sonia, we don't charge you any fees directly. Excite Capital is not charging you fees, but on every deal that we raise, we do have acquisition fees that is just standard across the board. You would imagine that all of this requires a lot of work, So for those of us that are putting it together, we need to still be able to pay the lawyers, to pay the CPAs, to pay all of that. So the fees that are associated with acquiring large properties like this is usually about 2.5 to 5%. Usually Excite does about 2.5 to 3% on most of our deals. But we are not charging you any fee, Sonia, as Excite Capital. The LLC, that owns the deal, was essentially charging that deal.
Okay. And the next question is, have you had any issues with maintaining optimal occupancy rates, cash flow for any of your properties? And if so, how did you manage this?
This is great. This is a fantastic question. Probably better answered by Leslie, but I'll take the first stab at it. So we have been incredibly lucky. So in this same day and age with the macroeconomic conditions where many operators actually stopped paying distributions. Some of them actually started to go to the investors and ask for more money. Actually, this is a good time to tell this story. One of our investors left the job and went to another job, and I had about $200,000. He saw us, he was a friend of mine. It was like, you know what, you like a relatively young company, so I'm just gonna put $50,000 with you guys from the self-directed IRA that I have now. I'm gonna invest $150,000 with more established names that I've heard of before, that are more established out there, and way more popular than us. I've done, I've been in the business for over 10 years, pretty much. Guess what? So investing in 4 different companies. All 3 of the others, so-called, experienced operators, have either stopped distributions or making capital calls, meaning calling them to bring in more money. And we are the only ones that have continued to pay distributions throughout all of this. So he called me and was like, whatever you guys are doing, just keep doing it, because from now on, you guys are going to be the ones, my go-to people. I said that to say that we understand who our avatars are. These are healthcare professionals who's worked hard for their money. These are underrepresented minority professionals who have worked hard for their money. So I take that and I echo this to all of my team members, and we are constantly harping on this, that we take this seriously. And so we would rather stay super conservative. Would rather not make, as much, but make sure that our investors are doing even that much better. Because this one deal is not what matters to us. We don't care about the short term. We care about the long-term, relationship. This is why almost 70% of our investors keep coming back and investing with us again, because they realize the passion that we have for this. They realize that, you know what, we are going to put their interest before ours any day, anytime. So because of that, we were very conservative when we underwrote. We were very conservative when we made promises. We would rather underpromise and over-deliver. And so because of that, a lot of people even made fun of us when everybody was going and getting cheap loans, bridge loans, and not buying any cap because it was more expensive so that they could make more profit. We chose the other route and decided that, you know what, we are going to go and get fixed long-term debt. We follow the immutable laws of real estate. We're going to buy for cash flow, and we're going to have a long-term strategy. So that is exactly what we've done. We've been able to maintain distributions, to answer the question more directly, on all of our deals. We've been able to not have a single capital call on any of our deals. And our investors are on the call, and they could attest to that. So, and we hope to continue that trend for the long term.
Dr.
All
Oni
right.
and Leslie, just to follow up on this, and you sort of touched on it, Dr. Oni, what separates us from those other 3 companies that are doing capital calls, that are going back to their investors? You sort of highlighted it a little bit about the type of loans that they're getting. Is there anything that you would note?
Just like I said, they were getting a lot of bridge loans. These are like variable rate loans that can just track with what the interest rates are doing, And so they got those loans at like 2%, but now the loans are at 9%. And so they are having problems paying their mortgage. They're having problems keeping the deal running. So, but we decided to stay with fixed rate loans. And so we got this, yes, we didn't get it at 2%, but there were maybe 3%, maybe 4-point-something%. But we are still nice and alive because we have been able to essentially continue doing well on these deals, despite of the inflationary and high interest rate environment.
And Chike, just to add to that question from an asset management perspective, nothing ever goes as planned, so you got to have the humility in this business. Is our pro formas, our projections are usually 100% wrong, but we project in such a way that it is wrong in a way that benefits us. So we have had properties where we projected that after maybe 6 months, the occupancy is going to be at 7%. But after 6 months, we had some issues with evictions and people that are staying in there, and the vacancy was higher than the 6%. But because going in, we're on the road so conservatively, allowed a lot of cushion to help us out for any unforeseen circumstances, those properties are doing well. So the conservative approach has been our go-to strategy. That is how we manage any unforeseen circumstances that come when it comes to managing this business plans. And Annette asked a question earlier, couple questions earlier that I missed. One was, how long have you guys been in business, and who finances the deals after you get the investments?
4 years in business. The person that finances the deal is, are you talking about where we get in the loans from? I think we talked about that already with Fannie Mae, Freddie Mac. Those are the agencies, but you could also get the loans from private banks, depending on what the interest rates are. But the vast majority of our deals have what we call agency loans on them. These loans are backed by the federal government. So Fannie Mae, Freddie Mac.
I love these questions, man. You guys keep them coming.
I love it.
The question is, how did the View qualify for the Fannie Mae loan?
Because we had some Fannie Mae experience, but also because we had partners that had Fannie Mae experience.
And Fannie Mae actually sends they actually send like an inspector to come and look at the property, review the business plan to make sure that it is a viable investment for them to give debt on. So they do a due diligence on the asset themselves, and they do a due diligence on the operators before they give the loan. And
yeah, so they wouldn't give the loan if they don't think that you can deliver on it.
Yeah. And I believe Sonia, we answered the question. Yes, you could invest with your trust. Chike, love the low risk taking strategy mindset. Thank you, Chike.
Thank you.
Annette, are you a member of the FDIC?
We're not a bank. No, we no, only banks that's the Federal Deposit Insurance Commission. No. So your investment is not insured by nothing. But I would add this to it. Without risk, there's no reward. So if you are not willing to take any risk, you just want to save, the banks love that. They'll take your money and take some risks with it and make some money on it and give you a tiny little portion of it. That's essentially what the bank strategy is, right? You bring your $100,000 to them, they go and invest in real estate, invest in different types of things, in treasuries and whatever it is that they invest in. They get a spread, interest of, whatever, 7 to 40% on it. And then if you're nice enough in your savings account, they'll give you 0.09% or 1%. If you have a high yield savings account, which every one of us have nowadays, they'll give you 4%, 5%, whatever it is. But if they're giving you 5%, they're making at least another 10, 15% on it. So all we're proposing is take the same risk that they are taking on your home. Partner with folks, like-minded folks who share your core value, and let's do this together. This is a team sport. We cannot do this by ourselves. We are only able to get to where we've gone so far because we have folks like you that believe in us and that have gone on this journey with us. What we're saying is we are just getting started. I think the runway to $1 billion to $2 billion, $3 billion in asset under management, where we have all of us working together and buying all these deals and creating generational wealth by investing in these deals, that runway is long. And the long term is really what we're looking at, not the short term.
And we have time for one more question, and this is the question from Sonia. What is the strategy of which property to purchase? Know that most are on the East Coast with one in the Midwest. What key ratio do you utilize for analysis? What do you present to potential investors?
These are all great questions. And that's the question that I could spend the next hour answering, but I'll give you the short answer. The short answer is, there's a significant amount of due diligence that goes into the particular areas that we invest in. Some of those considerations include one, the population growth of the area. That's one. Second is the rent growth that the area is experiencing or is projected to experience. That's two. Three, the diversity of employers in that area. That shows us that that area is not just dependent on one employer. You know, there are multiple employers. So if that employer goes, if one employer goes down, that does not necessarily affect our tenant base significantly. They could always bounce back. Third, fourth, we love areas with higher median household income, where the median household income is continuing to escalate, where it's starting to continue to get better, because that makes for a better tenant base. We also love landlord-friendly states. We also love state capitals. We love university towns. We love places with sports teams, because that usually is a sign that it's bustling and growing and has a lot of economic activities. We love all of these things and more. So, but also we're looking carefully at the micro environment, because real estate is hyper local, right? We want to look at the crime statistics of the environment. We want to look at the schools. We want to look at the big box retailers. We want to look if Starbucks is next door. We want to look if Walgreens is next door, or Wegmans, or, you know, all these key retailers that kind of have done a lot of due diligence, and we know that they're in the path of progress. We want to be right there with them. Like, for example, the deal that we got coming at, well, God willing, if we get the deal, it's right next to Starbucks and all this Target and all this fancy stores. It's going to be fantastic if we are able to get that deal, because, you know, people are always going to want to leave in that spot. You know, so it's in Atlanta, a city that's projected to continue growing for a long time, for the next decade at least. You know, it's in the path of progress, only a few, about 14-15 minutes from downtown. So it's a lot of exciting things. So those are some of the things that we look at when we're trying to buy these deals. And sometimes we look at proximity to the deals that we currently own, to, you know, because then we are able to even manage it that much better.
All right. Those are really great questions. We thank you guys so much for the engagement and interaction. On that note, Chairman Dr. Julius Oni, any final words before we wrap up the meetup?
I usually love this opportunities to interface with our investors and prospective investors. There's still a strong 25 people still on this call. I mean, that's incredible. We do not take this for granted that you took time out of your very important evening to spend time with us. We really appreciate you, and we look forward to answering even more and more of your questions, because we think you deserve it and you are worth it. We hope that you will consider us as partners as we move forward, and come join us at one of these property ownership groups. I think you will really truly enjoy the experience, and I certainly hope that we'll continue to grow your wealth, and that when this is all said and done, you will be on a bunch of this property ownership groups with us, so that we can all continue to grow and create significant wealth for us and all of our families. Thank you, everyone, and have a fantastic rest of your week. Bye.
Thanks, everybody. Thank you guys so much for joining us. Have a wonderful evening.